Welcome to the Truthbombs weekly recap, where I look back at what happened in the prior week and what to expect next week. So let's start with what happened in the market. I'm usually start on Monday, but I'm going to start with today because markets are really getting smacked today because of some comments earlier today from the president regarding Trump tariffs. We put out a video on that, so you should take a look at that and see how that went down. Let's go back to the beginning of the week. We had some very interesting news that happened on Monday. We had AMD announcing a big transaction with OpenAI. That was the big news. AMD, great stock. We like it a lot. It's up 80% year to date, probably prior to today. But that was big news for AMD. AMD has been making a lot of headway recently. Analysts like it. And now there might be a buying opportunity after today's market pullback. But that was the big news on Monday. And what that did essentially is, you wouldn't be surprised to hear, it helped pull up the S&P 500 and the NASDAQ. And both of those touched new highs on Monday. On Tuesday, we sort of had a sideways melt-up trade. Not much going on over there. And those on days like that, people tend to speculate on what the Fed might do next. The good news is we've had a lot of Fed speak this week. The Fed speak generally was slightly sort of middle of the road to slightly dovish, which is what the market's expecting. So not a lot went on Tuesday. Wednesday, we had a day full of AI optimism, and it was a unique day, right? Because on Wednesday, not because of the AI optimism so much, we had a very interesting thing occur. We had the S&P 500 close at all-time highs, and we also had gold close at all-time highs, specifically above 4,000, right? That's sort of a magical level that probably people would have never expected us to cross, but we crossed it. But the interesting part about what happened there is see, gold and the S&P 500 are kind of like the Hatfields and the McCoys. And so when you have gold going up, it's usually because people are fear. It's a fear trade. When you have the S&P trading up, it's a risk-on trade. Rarely do you have those happening at the same time. So again, it's like the Hatfields and McCoys having a barbecue, and it's very rare. So we have to take a look at that, and we did take a look at that. In fact, you should check out the video that we posted on that, where I go over the history of that and talk a lot about, why gold's trading here, et cetera. But the important thing to note on that day was when you have these weird events happening, it's really a sign of the times, where you have S&P and NASDAQ making new highs at the same time, where the fear trade, gold, is making new highs. It just shows us that we're in a situation where the markets are climbing this wall of worry, which you probably hear a lot about. I can't pronounce it properly, but the wall of worry. And so that is really what really is a sign of the times right now. And that wall of worry played into how the market traded today. I don't want to talk about that anymore because you can check out that video. So we had those highs earlier in the week. That brings us to yesterday. And yesterday was an interesting day because yesterday was the first signs that you could have had of the trouble that we had today with China, right? Essentially, China raised export restrictions for some of their rare earth elements. And if you've been following the narrative, we're very sensitive, the US, that is, very sensitive to these rare earth elements. And China is one of the dominant producers of that, right? So a lot of the negotiations that have been happening between the administration and China were around those rare earth elements. And so now China sort of is making moves to show that they may be pulling back. Really, honestly, that was viewed as, a sort of a posturing. As we come to this end of this 90-day grace period, which ends next month in November, a month from today, you see a lot of jockeying happening, right? So that yesterday was sort of viewed as China sort of jockeying. They also are announcing some more potential restrictions on chip imports, right? Importing to China. So that impacts the semiconductor market that is very dominant in our market. So, we had that. And so that caused a bit of a pullback. And that was like the first sign of trouble, right? Today, that trouble came back around, as I said earlier, as Trump fired back saying, oh, well, they may find themselves back at a 145% tariff. Well, markets obviously didn't like that. Markets right now, we're very near the close, are trading right near the day lows. When I say markets, I'm referring to the S&P 500 that is trading off. So that's kind of what happened in the markets last week. The interesting thing is this was a week that was supposed to have economic numbers. And of course, we didn't get a lot of these releases because of the government shutdown. And we're essentially flying blind at this point because of the government shutdown. And so in that vacuum of that we are in right now, traders are basically creating the narrative, right? And the narrative is generally around the Fed and the Fed funds rate. And we also are able to hear a lot of Fed speak, right? And I talk a lot about Fed speak. And so you have these FOMC members, some of them voting, some not voting, and they love to talk. And they're out talking every day. And even though they may be talking about some initiatives that they're working on, they always will generally comment on their feelings of rates, right? And markets are obviously very, very highly focused on rates, kind of like how my dog is very focused on treats, right? The market is looking for that treat, expecting that treat. So anything that they hear that might change that narrative for the market, that can impact the markets. So we watched that very closely, and that really, really dominated how the market traded in this past week. And if you look at the videos that we posted earlier this week, they were a little bit Fed heavy because that was the narrative that was going on earlier in the week. Of course, that's going to continue, but that is what was filling the gap this week. And of course, at the end of the week, we revisited troubles with China trade. And that's kind of what the week looked like. So normally, I would be able to go and look at numbers that happen over the week. We had no numbers, as I said earlier. However, we did get one number today, which I want to get to before I move to the next part of the segment, which is we got University of Michigan sentiment, right? And so there are two sentiment indicators. We have the consumer sentiment number from the Conference Board that comes out. Now I caught it. And of course, University of Michigan. Conference Board number is great. It's been around for a long time. The University of Michigan number is really interesting because it comes out twice a month. It's a preliminary release and then comes out at the end of the month. And what makes the Michigan number, for me at least, an important number is that they split up Democrat response versus Republican response versus independent response. And so, many people talk about these consumer confidence numbers and say that they're skewed, right? And this is the reason, because if you look at it, sentiment of Democrats versus Republicans, as you might guess, during Republican presidencies, Republican confidence is off the charts, and the Democrats are going down. We typically do see that. But what was very interesting, and I'm trying to bring it up here live so I can comment on it with you, is that we've seen in recent months a slight decay in even Republican sentiment, consumer sentiment, which is kind of rare. And that's something that we want to watch closely. And of course, Democrats, in fact, last month, Democrats increased sentiment while Republicans lowered sentiment, which is very rare. But we did see that last month. But today's number, we had the exact opposite, right? So you had a resurgence of Republican confidence and a continuum of the downward trend of Democratic confidence. The overall number was kind of flat month over month, so it's nothing to write home about. It came in maybe slightly better than consensus and slightly under last month, but that's an important number. And that brings me to the next thing, which is that we really are going to we can only rely now on these private numbers, right? Like Michigan, et cetera. Next week, we're going to have a whole different story. So next week, we're supposed to get CPI and PPI numbers, right? These are, of course, the premier inflation numbers that come out once a month. Unfortunately, those come from the Bureau of Labor Statistics, BLS. And you probably have heard a lot about that recently because there's a lot of contention between the administration and BLS. BLS is, by the way, is also the number that puts out the that puts out the monthly job reports, which also we missed last week. So that's something that we're going to miss also. And that's important because that is one of the two data points that the Fed looks at, jobs and inflation. And so we're going to miss that number next week. And also next week, we're supposed to get retail sales. That comes from the Census Bureau. And guess what? Shut down. So we're not going to get retail sales. Retail sales is also a very important data point. And you'll hear me talk about it in these segments often. We're not going to get that next week. Also next week, we get what we get every week. We get the weekly initial jobless claims numbers. That's how we sort of figure out where the monthly number is going to be. Now we're not going to get that. We didn't get it last week. We're not going to get it next week if the market stays if the government stays shut. Now, but what we will get next week, and what's going to be very, very important, is the start of earnings season, right? So Q3 earnings season starts officially next week. The financials typically kick off the parade. And of course, JP Morgan is at the head of that parade. And that's going to start early in the week next week. Just to give you an idea, of the importance of financials, financials typically set the pace of earnings season. Why do they set the pace of earnings season? Well, it's interesting. Well, first out of the gate, right? So if we see that those numbers are coming in strong and the narrative is positive, right? Everyone's got this sort of more positive view. But it's very interesting because banks, especially the large ones like JP Morgan Chase, they not only report how well they're doing or how well they did in the last quarter, but they give you an idea of how well their credit card business is doing, their consumer credit business. So that gives you a good read on how consumption, how healthy consumption is or was last quarter at least. And that is extremely important. And you guys hear me talk about that all the time, right? I'm a fanatical consumption follower. Why? Because consumption makes up 2/3 of GDP. And consumers being confident and consuming is what drives the economy. So we want to pay close attention to that. And we're going to be watching that very closely. Now, financials have had a pretty decent year. Remember, financials is a pretty broad, it's a broad sector, but the banks have done pretty well so far this year. And the reason they have been is because the yield curve is steepening. Banks tend to do better in a yield steepening environment. And when we expect it, when do we expect it to continue steepening, right? Because that's how they make their money, the spreads between short-term and long-term. But more importantly, these more diversified banks who do a lot of this investment banking activity, their banking activity has been increasing, right? Because more transactions are happening, which means they're collecting more fees. And that's sort of driven the narrative for the banks. They have done well. A lot of people are expecting them to do well. I'll give you an idea. We're expecting a little bit of a slowdown, but it's still a respectable 6.7% EPS growth year over year for the last quarter. So we're going to be looking for that. But we're going to get JP Morgan, Goldman Sachs, Citi, Morgan Stanley, Fifth Third Bank, which had a very interesting transaction last week. We're going to be listening to that very carefully. We got Wells Fargo. So we got all the big banks and we got a lot of the small ones. So that is really going to dominate what happens next week. And interestingly, we have been looking forward to this earnings season anyway, right? Because we already kind of have an idea of what's going on with the Fed, and the narrative is pretty much set with the market and with the macro view. So everyone was sort of looking forward to this earnings season, saying this is going to be what's going to determine how well the market does in the last quarter of the year. So everyone's been focused on this earnings season. That said, there initially, as we ended last earnings season, there were not high hopes for growth of this in this earnings season, but those have been tweaked up and up and up and up, leading to the actual moment, right? So everyone's getting a little excited here. And so there's going to be a lot of sensitivity to those earnings. So, expect even little misses to cause, big problems. And expect big gains, possibly not to move the market up as much as expected, right? Because they're published numbers, they're whisper numbers, and they're hopes. Everyone has high hopes. So you're going to see a lot of volatility around that. And that's what we're going to see next week. And that wraps up, your Truth Bombs weekly recap. Make sure you check back in every day because we drop bombs here every day. We drop the daily Truth Bombs and we drop them during the day. And of course, like every week, we're going to be back here doing our Truth Bombs weekly recap. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.